Welcome back to another Iron Financial Explainer. I'm your lead analyst, and my mission today, as it always is to help you forge a stronger, absolutely bulletproof portfolio, and to cut through the relentless market weakness we're seeing right now. Today, we are putting a true global titan under the microscope. We're going to run a brutal, uncompromising stress test on Shell's first quarter 2026 financials. Look, right now, we are operating in a macroeconomic environment that is actively hunting down and destroying weak balance sheets. Think about it. Persistent inflation, totally fractured global supply chains, and a punishing interest rate regime are separating the apex predators from the prey on a daily basis. In a quarter defined by violent geopolitical volatility and wild energy price swings, you absolutely need to know if the companies you own are built on a solid foundation of steel and concrete, or if they're just one macro shock away from completely crumbling to the ground.
And I'm the market skeptic. Because let's be real here for a second. When a massive oil and gas major posts their headline numbers, we have an obligation to you to ask the hard questions. Is this growth actually ironclad, or is it a giant, debt-heavy trap? Are these massive top-line figures built on genuine operational strength, or is this just an inflation mirage? We are looking at potential demand destruction out there, bloated inventory costs, and the constant, looming threat of a massive macroeconomic shock derailing the whole operation. Are the ongoing Middle East conflict and the sheer, unpredictable volatility of commodity prices simply masking severe structural weaknesses underneath? Today, we aren't accepting the polished PR spin. We are demanding absolute clarity from the numbers.
Exactly right. And to get that clarity, here is our exact blueprint for today's explainer. We'll start with the foundation, move into drilling into segments, look at shareholder reinforcements, dissect the ARC blueprint, run our debt stress test, and finally deliver the verdict. Let's get right into it.
We have to start with the foundation, the absolute heavy lifting of the quarter. $6.9 billion in adjusted earnings. Now, when you look at the extreme volatility in the energy markets lately, with wildly shifting natural gas prices and global supply chain bottlenecks everywhere you look, posting nearly $7 billion in pure adjusted earnings in a mere 90 days is a massive flex of structural muscle. To put this into context, in the fourth quarter of 2025, that number was sitting around $3.2 billion. They have essentially doubled their foundational earnings quarter over quarter. But let's zoom out and look at the historical context too. Just a few years ago, printing $3 to $4 billion was considered a wildly strong quarter for these guys. Delivering $6.9 billion in today's high-rate, high-stress environment proves they have completely redefined their baseline profitability.
Now, how they actually built that $6.9 billion is the real story here. This isn't just some lucky fluke of high oil prices lifting all boats. It is a masterclass in margin expansion. The products division alone delivered a massive $1.5 billion structural boost to the bottom line. And right beside that, we saw a $0.2 billion recovery from the chemicals division. This is absolutely crucial to understand. It proves they aren't just blindly selling more volume into a tight market. They are extracting significantly more value out of every single drop of raw material they run through their systems. They are fiercely optimizing crack spreads and capturing premium margins on refined products entirely separated from whatever the underlying price of crude oil is doing on any given day.
But look, earnings are ultimately just an accounting metric. If you want to know if a company's foundation is actually poured from solid concrete, you must look at the cash, $17.2 billion. That is Shell's cash flow from operations, excluding working capital, for Q1 2026. To put it simply, accounting numbers can be legally massaged with non-cash charges like depreciation and amortization, but raw, cold, hard cash flow, that cannot be faked. I want to heavily emphasize this metric because it represents the pure, unadulterated strength of the company's operational engine before all the accounting timing differences get in the way. It proves this integrated global portfolio is printing cash at a truly staggering rate, regardless of whatever paper write-downs they might take.
Okay, hold on a second. I need to interrupt the victory lap right here. You say the engine is printing cash, but I'm looking straight at the cash flow statement and I see a massive, glaring $11 billion working capital outflow. I mean, $11 billion. That is the equivalent of a mid-sized S&P 500 company's entire market cap just vanishing into the ether in a single quarter. I need a quick, no-nonsense explanation of what working capital outflow even means in the specific context. Is this just a temporary squeeze from rising commodity prices inflating their inventory costs? Or is this a permanent leak in the foundation that's going to end up drowning shareholders?
It's a very fair, critical question. Working capital outflow essentially means they had to tie up more of their own cash in day-to-day operations, basically buying much more expensive inventory and waiting longer on receivables.
The CFO noted this directly reflects the impact of higher commodity prices, and they fully expect a significant amount of it to reverse back into cash over time. But to prove the structural integrity is intact despite that massive cash drag, let's do a forensic, side-by-side comparison of the actual segments holding this whole company up. Look at upstream. It made a massive leap from $1.6 billion to $2.4 billion. Marketing more than doubled, jumping from $0.6 to $1.3 billion, largely driven by highly optimized convenience retail and premium mobility fuels. But the absolute showstopper here? Chemicals and products. Through aggressive, painful restructuring and much better raw material cost absorption, they went from bleeding $100 million in Q4 to generating a positive $1.9 billion in adjusted earnings. That right there is what structural integrity looks like across the board.
Okay, I'll admit the spreadsheets look great, but spreadsheets don't pump oil. What is the actual operational reality behind these numbers? Are they just riding a lucky macroeconomic wave, or are they actually executing out in the field where it actually matters?
Oh, they are executing flawlessly, and these operational wins are the actual steel beams supporting those financial results we just talked about. Down in the Gulf of Mexico, their Mars platform just became the first asset there to hit 1 billion barrels. That completely proves their deepwater pressure maintenance strategies extend asset life remarkably well. Over in Nigeria, they completed a major, complex maintenance turnaround at the Bonga facility 10 days ahead of schedule. Finishing 10 days early directly saves millions in capital expenditure and rapidly accelerates cash conversion by getting production back online faster. Brazil, hitting record production levels, and their global refining operation running at a staggering 99% utilization rate. Even when they face severe unexpected LNG outages in Qatar and tough weather constraints in Australia, the sheer logistics scale of their global portfolio meant the ramp-up of LNG Canada perfectly offset those losses.
So, the foundation is solid, the segments are executing in the field, but what does that actually mean for you, the investor? Let's shift our focus to shareholder reinforcements. Shell isn't just hoarding this mountain of cash. They're deploying a very aggressive, dual-pronged approach to value creation. We are seeing a 5% dividend increase for the first quarter of 2026, bringing the payout to roughly 39 cents a share. On top of that, they just announced a brand new $3.0 billion share buyback program slated for the next 3 months alone. By utilizing both of these methods simultaneously, they reward long-term holders with immediate tangible cash while aggressively reducing the overall float, which mathematically increases the earnings per share for everyone left holding the stock.
When you combine the dividends paid out and the shares repurchased, you get this massive number, $5.3 billion. That is the total Q1 shareholder distribution. I need you to contextualize that for a moment. This single quarter distribution is literally larger than the entire market valuation of many mid-cap energy producers operating out there today. Think about that. Any company that has the operational firepower to organically pay out $5.3 billion directly to its owners in a single 90-day period is a fortified wealth-building machine. They are aggressively shrinking the share count and juicing the yield.
But as any good strategist knows, to stay ironclad, you have to constantly upgrade the fortress. Let's break down the strategic blueprint of their latest major moves. In April 2026, Shell announced a massive $13.6 billion equity value acquisition of ARC Resources. This is a highly targeted strike to capture premium assets in Canada's Montney Shale Basin. For those who don't know, the Montney is one of the most prolific, top quartile liquids-rich gas plays on the entire planet. It's known for exceptionally low decline rates and amazing unit economics. This single tactical move raises their overall upstream and integrated gas production growth aim from a modest 1% up to 3% annually all the way through 2030. And how are they funding this? Partly through smart, ruthless capital reallocation, like selling off Jiffy Lube for $1.3 billion. They are intelligently divesting their lower-margin downstream retail assets to secure world-class, high-margin upstream natural gas assets for the future.
All right, I'm not going to let you just gloss over a $13 billion acquisition like it's pocket change. This ARC deal comes with a massive upfront cost. Shell's 2026 cash capex is ballooning to somewhere between $24 and $26 billion, and that includes about $4 billion directly tied to this ARC integration. Are they overextending themselves right at the top of the market cycle?
It's absolutely a calculated heavy lift. I'm not denying that, yes, 2026 capex spikes significantly to absorb the $4 billion ARC hit. But you have to look at the long-term framework. Their official guidance for 2027 and 2028 remains absolutely stable at $20 to $22 billion. They are using their massive free cash flow engine right now to swallow this $4 billion upfront integration cost without permanently derailing or inflating their long-term financial architecture.
Fair enough. But we are moving to the debt stress test phase of this explainer.
You can have all the cash flow in the world, but if your balance sheet is actively crumbling under excessive leverage, this entire fortress falls apart. Let's look at the actual debt.
Look at the gearing ratio. This is essentially the company's net debt compared to its total capital, and frankly, it is flashing red. A year ago, in Q1 2025, it was sitting at a very comfortable 18.7%. By the end of 2025, it crept up to 20.7%, and now, in Q1 2026, it has jumped all the way to 23.2%. This clearly indicates the balance sheet is carrying a lot more weight than it used to. When your debt is growing faster than your overall capital base, that is exactly the kind of structural stress point that can completely fracture a company when the macro environment suddenly turns against them.
And make no mistake, that rising gearing ratio is being driven by a truly massive figure, $52.6 billion in net debt. Just 3 months ago, at the end of 2025, their net debt was $45.7 billion. You could buy out several mid-tier exploration companies outright for that $7 billion difference. So lead analyst, I need you to justify this to the audience right now. How can you sit there and call this company an ironclad wealth opportunity when they just let their absolute debt load balloon by nearly $7 billion in a single 90-day quarter?
I can justify it because you have to look at how that debt is structurally composed, not just panic at the terrifying headline number. Yes, net debt went up, but ask yourself why. Look closely at the cash and equivalents. The cash pile dropped from $30.2 billion to $23.1 billion specifically because they spent it aggressively on those $5.3 billion in shareholder buybacks and dividends, plus funding their normal working capital swings. Furthermore, their lease liabilities rose by over $1.5 billion. Listen, lease liabilities are very often just accounting representations of capitalizing long-term ship charters and drilling rig leases. It's an absolute operational necessity to do business, not some reckless borrowing spree. But here is the absolutely crucial point for the Iron Financial audience. The core, heavy-duty borrowing, their non-current debt, actually decreased from $66.5 billion down to $65.5 billion. So the core structural debt load is actually shrinking, not growing.
Okay, even if I grant you that the core debt is stable, I'm still seeing hidden costs leaking out of this balance sheet everywhere. Take a look at this identified item from the quarter, a $2 billion loss purely from the fair value accounting of commodity derivatives. Let's explain this simply for everyone. Shell makes complex financial bets to lock in future prices and protect their downside, but when the market swings wildly in the other direction, those bets can temporarily backfire in a huge way. In a highly volatile market like we have now, these unfavorable derivative movements are acting like a massive, hidden tax on the company's underlying profitability, bleeding $2 billion right off the books.
And speaking of extreme volatility, we have to run a geopolitical macro stress test before we wrap this up. The raw macroeconomic risks out there right now are incredibly severe. Roughly 20% of Shell's global oil and gas production comes directly from the Middle East. We are already seeing major blockages in the Strait of Hormuz and actual tangible supply outages in their Qatar LNG operations.
You're right, those are very real macro headwinds that will fiercely test the structural limits of any energy major. However, when we actually analyze the structural resilience of Shell's specific portfolio, we see incredible built-in geographic defense mechanisms. Approximately 10% of their global volume comes from their massive heartland position in Oman. And the vital strategic advantage here is entirely geographical. Oman sits directly on the Arabian Sea and the Gulf of Oman. Its major export terminals completely bypass the Strait of Hormuz choke point entirely. So even with highly volatile supply chains globally, their integrated portfolio allows them to safely shift operations to open waters and remain highly profitable when others are completely shut in.
And this brilliantly illustrates the overall bull case for the company, summarized perfectly by Chief Financial Officer Sanad Gorman. She stated, "We delivered a strong set of results through our relentless focus on operational performance and the strength of our integrated global portfolio, navigating another quarter of uncertainty." That phrase, relentless focus, isn't just empty corporate speak. It ties directly back to that unbelievable 99% refining utilization stat we saw earlier. Despite severe macro headwinds, massive working capital swings, and preparing for a major multi-billion-dollar strategic acquisition, the day-to-day operational execution of this company remains an absolute fortress.
Which finally brings us to the verdict. We've torn down the foundation, we've strictly inspected the cash flows, challenged the debt structure, and weighed the very real geopolitical risks. Shell has undeniably proven they have a $17 billion cash-generating engine and the extreme operational discipline to return over $5 billion to shareholders in a single quarter, all while strategically upgrading their high-margin assets in the Montney Shale. But let's not pretend it's perfect. The cracks are there if you look closely.
a rising gearing ratio pushing past 23%, an $11 billion working capital bleed, and a portfolio still heavily exposed to some of the most volatile regions on Earth. It requires constant, unrelenting vigilance from anyone holding this stock. So we leave it to you. Based on the cold, hard numbers we've laid out today, do you have the risk appetite to forge your portfolio with Shell's stock, trusting their massive cash flow engine to power through? Or is a 23% debt load a fortress you'd much rather observe from the outside? Thank you for joining us on this Iron Financial Explainer, and we will see you next time.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.